There are three ways to make your mortgage interest tax deductible here in Canada that the rich have been taking advantage of since the 80s. Starting off with number three, the Smith maneuver. So this is the easiest to understand out of the three. Essentially, as you pay down your mortgage, assuming you have the right structure in place and you have a line of credit that's attached to your mortgage, you're going to increase the limit on the line of credit as you pay down the mortgage. And from there, you're going to borrow from the line of credit to invest. Now, what this is going to do is the interest on the balance of your line of credit is now going to be tax deductible. The investments that you are investing in from the line of credit do need to be qualified under the CRA's eyes. Now, the reason why you're able to deduct the interest on the line of credit is because under the CRA's rules, as long as you are investing with the purpose to generate income, this qualifies. Now, I highly recommend working with professionals like an accountant or financial advisor, and of course, a mortgage broker, because you do need to invest in the right investments in order for this to qualify. But assuming you have everything structured properly, this is going to accelerate mortgage pay down even faster because you're going to reduce the amount of taxes you pay at the end of the year. You're going to apply the tax refunds to the mortgage, increase the line of credit room, and repeat the process. And number two, the debt swap. This one's a more accelerated version of the Smith maneuver, and it's really cool because if you already have your investments, you're essentially doing the same thing, but you're doing it in one shot. So to give you an example, if you have $100,000 in non-registered investments, you sell those off, pay down the mortgage, and re-borrow that same amount from your mortgage, and then invest it in a non-registered account, you are now able to deduct the interest on that $100,000. So again, it's the same concept as the Smith maneuver, but you're accelerating it in one go. And the goal here is just swapping non-tax deductible mortgage debt into tax deductible debt. And the reason why I really like the debt swap is you're not leveraging any more than you already have. You already had the same mortgage amount. You've already had the same investment amount. You're just swapping the debts. And by the way, if you're interested in learning more about these strategies, give me a follow. And number one, rental cash damming. This one is specific for anyone that owns at least one investment property and it's owned in your personal name. So we've all been taught as landlords to take your rental income and pay your rental property expenses. Now, instead of doing that, take the rental income and make an extra payment to your primary home mortgage. From there, that's going to increase the limit that you have on the line of credit attached to your mortgage, and you're going to borrow from the line of credit to pay for the rental property expenses. And similar to the other two strategies, the interest on the balance of the line of credit is now tax deductible. And the really cool part is you're not leveraging anything in addition. You're not changing your cash flow. You're just changing the way you're flowing money. And by the way, all three strategies are 100% compliant with the CRA. If you want a guidebook on all three strategies, DM the word guide below and I'll send it over to you.